Hello, and welcome to Mornings with Joel, commercial real estate podcast, where we focus on rising stars and established players in commercial real estate and talk to them about how they are building legacies in today's marketplace. So Richard, good morning. It is so good to have you here today. Thank you so very much. We certainly appreciate it. As you know, this is the Mornings with Joel CRE podcast, and we're very excited to have you here as a special guest of ours today. And first of all, we want to offer our condolences, and we know you've had some personal losses as of late. I think you also lost another friend over this weekend.
Yeah.
And so I know you're going through it. So I do want to express our appreciation for you being here, and also, condolences for your losses there. So
thank you very much.
Thank you so much. Yeah. So just to kind of jump in right quick, you're senior vice president of one of the largest banks on the planet, and it's pretty impressive. So let's go back a little bit in time and tell us, how in the world did you even get to such a prestigious position?
Well, I took a tour, I'll just be honest. So I'll go back to my days at Morehouse. So I graduated there from Morehouse in 1995. And during that time, we had a real estate institute at Morehouse, and it was headed by a gentleman by the name of Alan Panado. Mm-hmm. So, and I was a finance major. And so during that time, we were interviewing on campus for various opportunities. But back in those days, commercial real estate companies just were not coming to HBCUs to recruit, right? So what I ended up doing is interviewing for a job at a bank, which was Wachovia Bank at the time. Mm-hmm. And so I interviewed, and they offered me a position as a budget analyst over in operations. And so I know I didn't want to do that. And so, I was a Fannie Mae scholar, so I was spending the summers in Washington, D.C. at Fannie Mae, learning how to securitize mortgages and, how they do those things. And so what I did is I waited until I got the letter from Wachovia Bank extending the offer. And so, we didn't have nice technology like we do now, right? So I waited till I got the letter in the mail. I opened up the phone book, called the commercial real estate department at Wachovia Bank, and basically just leveraged that offer letter to make my way over to commercial real estate. So what I ended up doing is talking to the person that became my boss and my manager and my friend. So that's how I got started. So I started, as a credit analyst, and got the formal credit training, and then I left there and went to work for Fulton County government in their real estate department. And so that was totally a different skill set because I got away from finance altogether. So I learned how to value easements, know what a right of way is, how to go through the condemnation process. So I learned real estate from a public entity perspective. Mm-hmm. And then lo and behold, and what you'll probably hear me, the common theme you're probably going to hear from me is all about relationships. So while I was at Fulton County, a guy I met, his name's Rod Teachy. I met him while I was in college. He came to speak to my real estate finance class one day. And so I was, very interested and eager to learn, real estate. So Rod and I, developed a relationship which evolved into a friendship. But anyway, he and I lost touch for a few years. And so he just so happened to be at Fulton County one day and came up into my department. And so we kind of reconnected. And so I would say maybe a year after that, he called me and, he said, Richard, I don't know what your situation is, but would you be interested in learning how to, do real estate development? I'm like, sure. So he was working at the Integral Group over there with Egbert Perry. And so he brought me over there to the Integral Group. So I learned how to do real estate development from the ground up. And so that was a fun job. So, I learned everything from the site selection to the planning to the architecture, dealing with general contractors. And that job taught me what I didn't like about real estate. And so what I realized is that I'm a straight finance guy. I don't care about architectures or working with general contractors. I'm I like the finance aspect of it.
Sure.
So I worked at Integral for about 4 years. And actually, I was on my way to the University of South Carolina, the Darla School of Business, to get my PhD in finance.
Mm-hmm.
And so as I was going through that process, I received a call from someone I used to work with at Wachovia Bank. They were at Bank of America. It was a job in what we call the private bank. And so basically that group, the private bank, we basically deal with specifically high net worth clients. And so we manage their assets. So never made it to University of South Carolina. I ended up going to Bank of America, working as a real estate investment manager at the bank. And so, I was working with a lot of high net worth individuals, helping them construct real estate portfolios and helping them come up with an investment strategy for it. And so I did that for actually 11 years.
Wow.
And so I left Bank of America in 2015 to be the director of real estate at MARTA. So from 2015 to 2018, I was the director of real estate over at MARTA. So that was a great experience as well. It was a great leadership role. I had the opportunity to go in and kind of help shore up the real estate department, which was fascinating. Mm-hmm. And then in 2018, because I had good relationships at B of A, I had a lot of friends over there. And so the role that I'm in now, the bank didn't have a presence in the affordable housing space, or let me say it like this. It had been over 10 years since someone worked in that role at Bank of America. So I was asked to come back. And so I went back to B of A in 2018. And basically what I do now is I provide debt and equity capital to affordable housing developers. So a lot of those developers typically get low income housing tax credits to build these projects. And so what I would do is provide the construction loan, and I would also buy those tax credits, which forms the equity in their deal. So that's my day job, and I'm also on the business school faculty at Morehouse College. So I teach real estate finance over there, and have been doing that for 14 years now. And I'm also a CCIM instructor, so I'll actually be teaching a class here in a couple of weeks, the financial analysis, the 101 class, in a couple of weeks here in Atlanta.
Okay, all right. So you ain't sitting on your hands.
No.
Yeah.
No, but it's a fun ride, though. I mean, I enjoy every aspect of what I do. I enjoy, because to me, this is one of those industries where, you can have fun doing what you're doing, and then you meet great people and establish great relationships, and then you have fun doing it, with the people you're doing deals with. So I find it very rewarding.
Yeah, absolutely. It's interesting. We've run in some of the same circles. I was just taking some notes of the things that you talked about, and even LinkedIn has us connected because I started my career on Wall Street at U.S. Trust, which was bought by B of A. So just going back all those years even. But I've got word that we've got to cut this a little short today, so we're certainly going to have you back. But let me just ask you this then. What would you say is one of the biggest challenges that minorities are facing getting into the CRE space, and how do you think we can help, or Bank of America can help?
Well, I think the biggest challenge for us is more or less exposure, and it's also building those relationships. And so, I'll just give you an example of even in my teaching side at Morehouse. We have a finance department. I told you we had a real estate institute years ago. That was back in the mid 90s. But the only real estate course that's offered at most HBCUs, if any, is a real estate finance course. Mm-hmm. So I think it starts there. And I've spent most of my time when I'm over there teaching, not only teaching them the subject matter, but talking to them about the different career paths in commercial real estate. So I think that's the first thing. And then the second thing is building relationships early. Kind of gave you my story about my relationship with Rod. So I met him, and I was actually sitting in the real estate finance class. I was a junior in college. So I think if we could kind of shore up those two things, and I think also this commercial real estate industry, to me, it's a marathon. It's not a sprint. It's not a let me do something today and reap a benefit tomorrow. I mean, maybe years down the road before you actually see some fruits of that labor. But I think we have to stay diligent. We have to stay focused, and we have to continue to expose our young people, and also people that are on this call. We need to continue to have these conversations about it, and be selfless and point people in the directions in which they want to go.
Yeah, that's a very good point. One thing you brought up was relationships. And it's amazing how, for myself, being over 20 years in the game, over 25, I look back and a lot of the folks that I'm connecting with now are people that I need to talk to moving forward,
Yep.
right? But I didn't think that relationship was necessarily going to bear any fruit maybe 20 years ago, right?
Mm-hmm.
So you just don't know. It's good to keep in touch with folks, not burn bridges, and continue to work those connections. So, that's a very, very powerful point. Let me do this because since we've got to end a little bit early today, what I'm going to do, if you don't mind, for all of our guests that are here today, we'll stay on after Richard has to drop. And I would like to hear from you guys as to what things you would like to cover with Richard when he comes back, what other things you would like for us to have on the show, and other different topics in this regard that we can cover in the remaining 30 minutes or so as we go to 11. But Richard, let me open it up. Well, first of all, is there anything else that you wanted to share with us that you want the next generation to know about as we continue to educate here?
Well, first of all, let me say, Joe, thanks so much for having me on. And, I really am looking forward to coming back and continuing the conversation, because I think it's one that needs to be had on an ongoing basis. And we need to put in the work, we need to strategize, and we need to help us all, get to the next level. And like I say, expose that next generation to this industry, because we are so underrepresented. And so just to be, amongst people like you, it gives me, some hope, and I'm very privileged to be able to work with you guys.
Well, thank you. Certainly appreciate that. So let's do this. I'm going to open up the lines. If you have any questions, either put them in the chat, or if you can raise your virtual hand, that would be great too. And we'll be happy to get those comments of anything that you have for Richard. And while we're waiting on those coming in, let's talk a little bit about deal structure. You mentioned that B of A will do the tax credits, and by those tax credits, like you said, becomes the equity in the deal for affordable housing.
Right.
Are there any limitations on where you would go, or what the underwriting platform calls for?
No. Yeah, so there's no limit, Joe, to where I go. I typically go, wherever my clients go. So if they decide they want to do something, outside of Georgia, I'll certainly go there with them. But in terms of deal structure, though, Joe, one thing about it, these deals are very complex. So there are. When you talk about capital structure,
Mm-hmm.
there are so many layers to it. There's, these deals typically have public-private partnerships. So, Invest Atlanta's involved, Atlanta Housing's involved,
Mm-hmm.
The Beltline's involved. And then you have the Department of Community Affairs involved. So those are just 4 entities right there. And then, I come in. So we have to make sure the deal pencils out from a standpoint of making sure that we call it the debt coverage ratio. So that's basically making sure that the deal generates enough cash flow to service the debt.
Yep.
And typically, they will. And then, we also put, from an underwriting standpoint, we also put what we call completion cushions in place. We put financial covenants in place just to, make sure the bank's risk is somewhat mitigated, or the deal is not overly risky. And also it helps the clients as well, because if we underwrite from a conservative perspective, it helps them because those cushions do come into play, as you move through the development process. So I hadn't seen one that's been easy, Joe, to be honest with you, but but they're fun, that they're fun to work on because you have to, it's really a collaboration between, the public and the private sector to get those deals done.
Right. Yeah, I tell people all the time that every deal is like a fingerprint. There is no identical deal, right? Every deal you think is a slam dunk is not a slam dunk, right?
That's right. That's right.
So that's how it goes. But but let's dive a little bit deeper real quick just so our audience understands, and then Uriah answer one question we had in the chat box. The deal structure from the standpoint of like how much leverage will Bank of America generally do on an affordable housing deal? How much equity do you get involved in the equity stack from the GP and the LP side, or is it just the debt piece that you're restricting and requiring capital on? What type of covenants are you looking for the developer as regards capital and assets so just some of the details related to that.
Okay. Well, now, that's the beautiful part about these deals. So typically my typical deal is about 30 million, give or take, right? And so the construction loan on that deal would be maybe anywhere between 18 and 20 million or so. And so this is doing construction, right? And so the construction process on those deals are normally anywhere between 18 to 30 months. And so basically what happens is with the tax credit equity, with Invest Atlanta's funds, with DCA's funds, because they may have some what we call National Housing Trust funds in those deals. When that deal gets ready to convert to permanent from a debt service standpoint, their loan to value is typically less than 50%. Because you have those tax credits and all these other grant dollars that came into play. So I see that more often than not. But I also have seen, from an underwriting standpoint, the permanent lender, because that's the lender that actually take me out from a debt standpoint. They'll do, about 80% loan to value. They'll underwrite to that, but those deals typically, the loan to value is a lot less.
Yeah. So on the construction side, roughly 50 to 60% leverage.
Yeah.
And I'm assuming Fannie Freddie comes in.
Yes.
And generally takes those out. So okay, all right, sounds good. What type of covenants are you generally looking for on the developer?
So typically what we'll do is we'll look at, we look at liquidity covenants, we look at net worth covenants, and we look at what we call contingent liabilities. And I walk through all three of those. Yeah. So
let's say a $30 million deal. Just use it as an example.
Okay. So that $30 million deal, I want to see about, $3 million or more in liquidity. I want to see a net worth of about 20 million or so. And contingent liabilities, basically what we're looking at there is what other projects do they have underway that they're on the hook for. Yeah. So what we want to do is make sure that they're not, stretched too thin. So we'll look at those three parameters. And then in the loan documents, we will place these covenants in there. So we'll say you got to, have that $3 million of liquidity, for a period of time, and you got to maintain your net worth at, that $20-30 million for a period of time. And, your contingent liabilities can't exceed typically, if it's a large developer, I mean, it's common to see contingent liabilities of 100 million, and so what that means is I may be looking at this deal, but they may have 4 or 5 other projects going on somewhere else that are financed by, different banks. But what we want to do is make sure, that's why that liquidity number is so important. But we want to make sure if there's a capital call on any of them, you have the liquidity to keep going and not put me in jeopardy, right?
Right, exactly. All right, sounds good. Are we doing on time? Okay. Sabrina, you had a question. Do you want to verbally ask it, or you want me to just read it off here? Give you a couple seconds. All right. Well, let's just read it. It says, what kind of language is written into the contract that would protect the investor in these deals if there is a natural disaster that could delay the construction process? All right, good question.
That's a great question. That's a great
How would you
question.
answer that, Richard? Yeah.
So yes, there is language in the loan agreements that protect that. We call that force majeure, and so that does protect the developer and the bank for that matter. For any type of natural disasters that may negatively impact the project. But we make sure that's in there.
Okay. All right. Sounds good. Sounds good. Well, let's see here. Richard, what can people expect to learn in your awesome upcoming class?
Well, it's all about, real estate finance. So that 101 class is called Financial Analysis for Commercial Real Estate Investment. So
the fundamentals class, yeah.
Yes.
Mm-hmm.
So we talk about everything from market analysis to how to analyze a deal. We talk about the different methods that we bring in, the taxation piece of it. And so what we actually at the end of the class, what we would have done is 4 things. We would have analyzed the deal before and after tax. We analyzed that same deal without debt, and then what's the impact of leverage. So it's 4 days. It'll be 8 hours for 4 days, so that's 32 hours. But it's jam packed with a lot of information, and it's a great course. I love teaching it. And so somebody asked, how could they sign up? I think you can go to the Georgia CCIM's website and register for the class there.
Okay. All right. Sounds real good. So, well, we're at 10:29, so we're going to cut you loose. We certainly appreciate you being here. As I mentioned earlier, everyone else, if you can stay on for a minute, that would be great. If you got to leave, we certainly understand that. But Richard, let's try to get you back. Maybe sometime in March. I think we're booked up until that time, or maybe April. But we would certainly love to have you back, continue the conversation, and get a chance to go a little bit deeper. And again, apologize. Sorry for your losses, and
appreciate it.
We understand why you got to cut things a little short today.
I appreciate it, and thank you all for having me. And I look forward to coming back in March.
Absolutely, without a doubt. Right. Thank you again, Richard.
All right, y'all take care.
Yep, have a good day.
Right, bye-bye.
Okay. Well, we appreciate you guys. Thank you so much. This has been the Mornings with Joel CRE podcast. We certainly appreciate having you here today, and we look forward to seeing you next week. You guys enjoy your week and have a great rest of your afternoon. Take care, everyone. You've been listening to Mornings with Joel, Commercial Real Estate Podcast, where we focus on rising stars and established players in commercial real estate and talk to them about how they are building legacies in today's marketplace. Please check back weekly to hear our upcoming guests.